If you're thinking about filing an offer in compromise, the real question you're asking is simply, how much will the IRS actually accept from me? Because you've probably heard the ads about settling for pennies on the dollar, but you're looking at your actual balance and wondering whether that's real or whether the IRS is just going to demand more than you can possibly pay. And here's the tension. The IRS doesn't care what you owe. They care what they believe they can collect from you. That includes your income, your bank accounts, your home equity, even your spouse's income in some cases. I'm John Sterbick. I'm a tax attorney here in Tacoma, and I've negotiated offers and compromise with the IRS for clients across the country. And I can tell you, they use a strict formula, not sympathy. In this video, I'm going to walk you through exactly how that formula works, how the IRS calculates what they think you can afford, and what that means for the number they'll actually accept. So by the end of this, you will have a realistic sense of whether you might qualify to settle or whether submitting an offer right now could lead to rejection and even more pressure from the IRS. The number that actually matters. When people ask me, how much will the IRS take? What they really mean is, can I settle for less than I owe? Sometimes, yes. But the answer depends on something called reasonable collection potential, or RCP. This is the formula the IRS uses to decide whether to accept your offer. It's not based on your tax balance, it's based on what the IRS believes it could collect from you through enforced collection. Things like wage garnishments, bank levies, or property seizures. Your offer has to equal or exceed that calculated number. If it doesn't, the IRS will reject it. So the real question becomes, what does the IRS think you can afford? That calculation has two major components, your assets and your future income. How the IRS looks at your assets. The IRS looks at everything you own that has value. Your home, your vehicles, your bank accounts, retirement accounts, investments. They will calculate your equity, what your property would sell for today minus what you owe on it. If you own a home in King County, Pierce County, or any area where property values have increased, you may have more equity than you realize. Interesting enough, the IRS does refer to Zillow in my negotiations. Redfin, not so much, but Zillow is an accepted means of determining the value of your home. If the IRS determines you have $40,000 or $50,000 in equity, that amount is added directly into your offer calculation. And here's where Washington law becomes important. Washington is a community property state. If you're married, the IRS may consider your spouse's income and assets, even if the tax debt is only in your name. I've had clients surprised to learn that your spouse's earnings affected your settlement. That's something you need to understand before submitting an offer. Because when you're in a community property state, you take a look at the community itself and what income is derived from the spouses. The second major part of the formula is your income. The IRS reviews your monthly income and subtracts what they consider allowable living expenses. They use collection financial standards to determine what is reasonable for housing, utilities, food, transportation, and healthcare. In higher cost areas like Seattle or Bellevue, the allowable housing amount is typically higher, which can work in your favor. But don't forget, it's just an average. Any of these standards that they want to lean on and use to determine how much you get in an offer and compromise is just an average. But if you're spending more than the standard allows, the IRS may not count the difference. For example, if you earn $4,000 per month, and the IRS determines you have $800 left after allowable expenses, you treat the $800 as available to pay your tax debt. If you submit a lump sum offer, they multiply it by 12. If you propose paying over time, they multiply it by 24. It means your income portion alone could be $9,600 or $19,200. Then they add your asset equity. That total is generally the minimum they will consider. What if you can't afford that number? If you can't afford the calculated amount, there are still options, but they require careful documentation. Healthcare premiums, child care costs, and certain secure debts can affect your disposable income calculation if properly. They have a standard for food. But if you have a doctor's note that requires you to be on a special diet, your food bill might be higher than the average. Timing can also matter. If your income was temporarily high due to overtime or a one-time event, that can sometimes be addressed. In certain cases, hardship may apply, especially if paying the calculated amount would create significant financial strain. But hardship isn't about emotion. It's about clear financial evidence. Don't forget, we're dealing with a big bureaucratic agency. They don't care about your emotions.